Welcome to the Second Bite podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Welcome back to the Second Bite podcast. My name is Todd Taskey. I'm your host. We've got a really interesting episode today with Peter Stavisky from Barrington Media Group. Peter, super happy to have you.
Hey, great to be with you, Todd.
We got a lot of good stuff to get into. You've grown a tremendous business. You've partnered with private equity. You've made some acquisitions. I know you're looking for additional acquisitions. So I'm excited to get into our conversation and unpack that quite a bit. Before we do, I just want to say thank you to our sponsors, the people at TeamShares. TeamShares is a little bit different type of private equity group. Peter, they're out of Brooklyn in New York City. They focus on smaller companies in the $1 million to $2 million EBITDA range. They're an all-cash buyer, really great group to work with. We've closed a transaction or two with them, and hopefully we'll be able to do more. But TeamShares is a really interesting private equity group for those that are looking not to partner with private equity to grow like you did, but looking to exit their business fully and leave it in really good hands, because after acquisition, TeamShares looks to get a majority of the equity in a business into the hands of the employees, which is a pretty unique model for them. So teamshares.com, you can go check them out. Anyways, Peter, let's talk about Barrington. Give me the description, if you will, of what Barrington does and who you do it for.
Yeah, thanks, Todd. So we consider ourselves a customer acquisition platform, and we're really agnostic to the channel. Many clients come to us because maybe they just want to break into customer acquisition for audio, or maybe they need a television partner, or maybe they need help with their search or their social. Maybe they just want to get into podcasting. So we're very comfortable whether a client comes to us and they just look at one channel and work with our experts in that channel and drive customer acquisitions. In other words, getting more customers for them at or below their acquisition targets. And they'll come to us for that. We're very comfortable taking someone on a one-off basis, one channel basis. And then once we get confidence, they become confident with us, then we cross-sell across and introduce them into other channels that may work well for them. Other clients will come to us and they really want omni-channel. And we're one of the very few, and I mean really very few, pure omni-channel plays where we can use one channel to inform another channel and really drive down acquisition costs across. So we can build out a full omni-channel platform for clients, and many of the big clients are looking for a true omni-channel play. And so we can do channel by channel or across all channels.
All right, if I can be direct,
Sure.
First time I heard that, and the first time I heard you say performance radio, I said, geez, this is, kind of nonsense, because people don't do that. And more than that, a lot of people say the words that you said and just don't do any of the things that you're really saying. So can you, in my words, would be, you really do performance on what I would consider old world marketing, right? TV, radio. And so can you talk about what you actually do? Maybe even give a short case study?
Yeah, we do. And we do it both with a client's brand or what we'll call a generic brand. We call them Barrington branded ads. So we can create an actual brand to go out in the marketplace and then funnel those leads or calls to the client, giving them just another whole stream of callers or potential clients.
So give me an example, like with radio.
So I'll give you some category examples. So for Medicare, for example, we do sort of branded ads with our clients' names in them, or we own a brand called Medicare Advantage Advisors, and we run those on TV. They come in and hit our call platform, and then we sell those to clients that have licensed agents that can buy those calls from us on just a per telephone call basis, so pure performance. And clients really like it because if they have licensed agents which are more expensive than, say, pure call center agents, those folks are expensive to have sitting in the seat. And so two things are important to them. One, they don't want them sitting there idle, not taking calls, because then those either they're spending a lot in labor or if they're paying them on a commission basis, those folks are frustrated that they're not getting enough at bats, and they may go work for someone else. And then the flip side, which frustrates clients even more, is if if there's too many calls. If there's too many calls and they're hitting the floor, and if they're hitting the floor, then their CPAs go up. And so by joining our program, we're able to send them calls just during their call center hours, just to states where they have licensed agents that are available to take those calls, and to regulate the call flow so that we're keeping them busy, but not sending them calls when they're at capacity. So for all those reasons, clients really like to receive our calls. They may be taking some branded calls and keeping their queue 60% full, but they don't want to be trying to fill it fully, because it's impossible particularly with television ads. When they're dropping, you're going to have too many calls. And so with our process, they're able to log in and keep their agents busy. And so it works out really well.
Yeah, and when you look at it from today, looking back, it looks relatively easy, and you can tell that it is genius in terms of what it does for the client. But this has been 20 years in the making. Can you describe just a little bit, give us an idea of the size of the business?
Yeah, so now we have currently we're about 250 employees and over $500 million in media annually.
And in terms of revenue, can you give me a range?
Yeah, so gross revenue, we're up over I said 500 million range.
That's fantastic. And that includes all your media buy and the rest.
Yes.
Got it. And so let me go back. You started in 2003, and then you went for, I guess, roughly 16, 17 years. And then you partnered with private equity, right? The people at Fort Point.
Right.
Take me back to however long it was before you did that in February of 20, right?
Exactly.
So what was going on right before COVID? So that, I guess, felt good. But what was going on, let's say, in the tail end of 19 in your mind that made you decide, I need to take chips off the table, I need a partner, I want to do acquisition, I need to really accelerate? What were you thinking?
Well, I have to even back up a little bit before then. We started talking with a investment banking, an advisor, probably for a period of 5 years. And every year they would say, hey, you should think about taking chips off the table. And every year I would say, well, we're still growing. I don't know what the right time is. And even when we did the deal, I was still saying the same thing. I don't know when the right time is to do this. And I think that's sort of that magical point, is that you never really know when the right time is. You'll hear, hey, you got to take chips off the table. Obviously, if you think you can keep growing, maybe you should wait a little bit. But ultimately, it got to the point, and the team got to the point where we were really, I describe it as, we were a single member. I was a single member LLC, had 100% of the business. I was, providing nice bonuses and profit sharing to some of our employees, but held 100% of the company. And it was really at the point where we needed a bigger structure. We wanted to get, formally stock options out to our employees for incentive. If something happened to me, what was the succession plan? There was no, I said we went from almost like a bicycle frame to an a Ford 350 frame, and I think we needed to do that. We were running on a cash basis, and so we had to do a lot of things to sort of line ourselves up and be ready for private equity, and those things we avoided for a while, but ultimately got to the size where it was just more responsible for our people, and also we had organically grown for 17 years. We didn't do any acquisitions, and I think that going to private equity allowed us to, that confidence of somebody to look at the numbers and sort of look over your shoulder in those acquisitions to make sure that you were going in the right direction. And so it provided an opportunity to take some chips off the table, and I think that ultimately that's great. But there were other driving reasons to do it as well.
Yeah, so let me push on that for just a second, because a lot of these episodes, if you go back and listen to them, are guys that have partnered with private equity. But to be really fair, you were in the exact same position in 2018 and 2019 right? And you didn't do a transaction, and it turned out you grew, and there was all the reasons to do it, and was there, because a lot of the guys I work with struggle with it, right? And as an entrepreneur, as you know, the blind spot is next year is always going to be better than this year. And that's always true until it's not. And then when it's not, all of your options shrink, if not disappear. Can you go back to that? And was there any like kind of clinching moment or thing, or did you just finally wear down and acquiesce to the idea?
I think it might have been a little bit of that, but mostly it was the numbers got big enough where, I really looked at it a couple ways. One, I had enough chips coming off the table that I was going to be comfortable for the rest of my life.
From the PE deal up front.
What's that? Yeah,
From that first deal with
from the developer. So I think enough to feel that. I also had a lot of confidence in the business, and so I retained as much as I possibly could. I kept 40%, out of the gate, and and the business has tripled, near tripled in size. So at a point where we do a recapitalization or whatever it is that we look to do down the road, the second bite of the apple will be bigger than the first. And so I grew up poor, and I don't need a lot of money, and I had to force myself to buy my first $200 pair of jeans. Was buying $30 jeans, so this was all sort of surplus in my mind.
yes.
But I think it's great for our people and for the growth, and there was a lot of things that just sort of made us feel a little more adult with this move.
So I want to dig in and understand why you chose Fort Point, but before that, doing the transaction or since the transaction, has your risk tolerance shifted at all? Based on your comment, do you feel like you're playing with house money, so let's accelerate as fast as we can, or is it about the same that it was?
I think it's the same. So, some people said, "Oh, this is great. You're going to finally be able to relax a little bit. You'll work less. You'll take more vacations." I took less vacations. I worked harder, probably the last 2 years than I did prior, which was sort of hard to imagine. But we take the responsibility, very seriously. Some folks took a chance on us and invested in the business and put their dollars in, and so we respect that and work hard for that. But it's really also for the employees. Now I have employees that have unit incentives, stock options, and so I want to see them do well. And I've made my money, but to see them do well is important to me. And so having the health of the business good, so that we never have, now we're coming into, some people are saying recession. We've never had to lay off people, and it's because we manage our numbers well, and we have for nearly 20 years now. And so providing a good place to work where the environment is great, and the culture is fun to be in. It's challenging. We're in a tough business. The agency business, servicing customers is not easy at all. There's competition, and clients' expectations are high. So it's a tough business, but it's fun. And we happen to be very good at it. So clients like to utilize us. But we want to take care of our employees, take good care of our clients. And now the new part of making sure our investors do well too. So we want to do well for everybody, and provides great opportunity for our people to excel in their careers.
And so in the 2.5 years since Fort Point, you've tripled EBITDA. I don't know what happens.
We're not there yet, but pretty close. Yeah, pretty close.
All right, so you've about tripled. I want to talk about that in a second. I also want to talk about kind of what you have on your priority list, but I want to dig into the acquisitions that you've done. Let me ask you first, though. I would imagine you had a lot of choice in terms of the private equity partner that you had. Can you just tell me briefly about what the process, maybe your biggest memory from the process, but then what was it about Fort Point that made them the selection?
Yeah, no, it's a great question, and they didn't even have the highest cash price out of the gate. They provided us with an earnout that when you added that together with the initial price, would have been the highest deal, and we did hit 100% of our earnout, so it did ultimately pay the highest price, but it wasn't the largest cash price. So it wasn't as much price as fit for us. They had one partner there, Christina, who we thought was really sharp, We thought we could work well with her, and we thought that that they would be a good we always viewed this as and they do too, as sort of a stepping stone, right? This is your first private equity deal. They only take you to a certain size, and then you recapitalize from there and go into a middle market group. They're considered more lower middle market, and so we never really viewed this as a long term proposition. They gave us a 5-year plan, and we looked at the 5-year plan and sort of poker faced and said we thought to ourselves we could do this in no more than 4 years, probably do it in 3. We hit their 5-year financial goal in just about 2 years. So knowing that we could win the game before we started, and knowing that we sort of it was interesting. A lot of people say no one's going to like private equity. There's a lot of negative connotation to it, and so I was warned early on, you're not going to like your private equity group, no matter who it is. And I think I was just sort of wrong. We do like our private equity group, and it's different. It's getting used to a different sort of culture and thinking. But there's a lot of mutual respect there, and so we're happy we picked them. We also thought that the fact that they were in Boston, it was sort of the same thought when I was going to college. I went a couple states away. I wasn't too far away where I couldn't get home, but I wasn't close enough where they could just pop in and say hello. So,
Right.
Same thought process.
Very good. So let's go now. You've got a private equity partner. Sounds like your personality type is one that says, wow, now I really got to start to perform, right? No more hanging around the office, so to speak. So you did that deal in February of 20. And then later that very year, you did your first acquisition. Did you feel pressure to do an acquisition to get something on the board? And so you did Blackbird was your first acquisition. What do you remember about that?
Yeah, it's sort of a whirlwind. We were always used to growing organically, and so I think in the first one we were really sort of relying on on our partner to help pick that. And I think as each deal has come through, we've gotten better and better and more taking the process internally now. Now we have a CFO and a CTO, and we just built out the C-suite, and we're just we're just more poised to to be able to evaluate deals internally. We're still utilizing the private equity guys to overlook the deals, but we're doing the integrations. We're doing everything in house now, and I think that's that's important. It's always been part of the way that we've looked at things. So I think the process has gotten better and better, each time that we've gone. Each acquisition we've done, we've gotten a little better at it.
Yeah. So we on a couple of recent episodes, we talked to Matt Sunshine from CSS, and part of their stated objective, they want to do acquisitions as well. But for their first one, they want to do a small one. When we did that transaction with Worth e-commerce, we sold them the SmartBug. It was SmartBug's first acquisition as part of American Discovery Capital. And they wanted to be on the smaller end to make sure they hit it right, make sure that if it's not completely right, it's not a disaster, and then kind of test the systems. Was because Blackbird was smaller than 5 mil was, correct?
Right. Yeah. Yeah. And not even, you look at it both sides, right? So one is employee size and the size of the business, and then also EBITDA. So, Blackbird's EBITDA was strong, but very small. It was just two people in that deal versus, 30 something for 5 mil. And ultimately, when we closed the thesis deal, they had, 85, 90 people. So each group came in was a little bit larger.
And so Blackbird got you into digital, and then 5 mil kind of strengthened that with a larger acquisition. And then you got real specific, right, with thesis, because that's more of a conversion rate optimization focus.
Yeah, absolutely right. So Blackbird focusing on social content network, 5 mil being real experts in the search side. Of course, they have some social too, but a large majority on the search side, with a team of 30 or so experts and that have been doing search for a long time. And so that was a really great acquisition there. And then those teams really even helped drive the thought process on the thesis deal. Actually, it was actually referred by Dan and Susan over at 5 Mil that knew Adam at thesis, and it really resonated in my mind because on the offline side, clients really count on two things, to differentiate you, so creative is a big piece of what drives offline media success, and then optimization. And so when we looked at the assets we had with Blackbird and 5 Mil, we felt like we had really good talent on the buying side, but there wasn't as much optimization or creative. And what these brought us with the CRO side was a large creative team and a large tech that allowed for quick optimization. So they were able to build the landing pages or improve the websites quickly with technology to really look at the traffic coming in and getting it to convert. And so we thought it was really powerful because if you can buy better, that's great. But we were relying on traffic to go to clients' websites. And so, we really wanted to have that real full service, capability that we have on the offline side, where we're not only buying and driving the traffic, but then we're we have the tech and creative to make sure that we're converting well and generating well. So the thesis purchase helped us put all of that together, as well as bring in a tremendous amount of talent too.
Yeah, and so let's talk to the smaller type of agencies that are thinking about being acquired at some point in the future. Now that you have done 3, forget the service that the business offers, but if you were going to point to 1 or 2 things that you really wish those guys would do to make the transaction easier and then to make post-transaction integration easier, what would you hope they're already doing themselves?
It's a great question. I think as and I went through this a little bit as well. When you've built something, and you're going to become part of another organization, I think making sure that you see it as a good opportunity for your people, that the culture is right, that people are going to be motivated and excited, and that you're providing a better place long term for people to be, is really important. And as I talk with CEOs and founders out there that are trying to decide, what do they do from where they are now, I always say to them, like, you could go the PE route that we went. If you get to a big enough size, you can go there as long as you're willing to build out and go to from cash basis to accrual and put in put in all the the tech and the C-suite that you need to to keep the private equity folks happy. You can certainly go that route. But I think in our industry specifically, I think most founders are realizing that, and we're seeing the benefits now, where we're seeing the cross-selling going on. We see a tremendous amount of business from the digital side that want the offline side. They want to do audio. They want to do podcasting. There's a tremendous opportunity. We've seen a good uplift in our business. That's part of what's driving it is the cross-sell business. They're starting to realize that they can't make it stand alone. There's too many clients that are shifting that really want that omni-channel. They want to have the ability to go to a platform that can look at their traffic and optimize it across. And so you either have to be in a position where you're saying, I'm going to build it out, or I got to become part of another organization. And then, are you going to find an organization that has the spirit and the enthusiasm? From our standpoint, we don't really want a lot of overlap. We want to bring in, experts in areas that we don't have, and so they can continue to run the business. We want to retain all of our people. We're not looking to, do an acquisition for cutting costs and, cutting, employees. Our view is, to do acquisitions where it's a true bolt-on or add-on or creative to the business, where we can keep everybody and continue to grow and continue to make it a bigger, better place for everybody to, to work and grow in.
And I want to talk about those areas specifically in a minute. Can you tell me how you think about structuring a transaction and then how you think about integration? Because as you know, if there's a long earnout or a specific earnout, it can slow the integration into what it is that you want to do. How are you guys managing that at Barrington?
Yeah, so the way we think about it is, is somebody who wants to roll, some of their, proceeds into Barrington stock. Quite frankly, I think all of the CEOs have done really, really well rolling their percentage that they've rolled. 20, 30%, whatever it may be. Has paid off. Would pay off more than taking cash in, and I think it also helps sort of motivate. From our standpoint, it's less cash that we're having to put out, so we're able to do more deals and making sure that people were sort of aligned, going forward. So being able to take chips off the table, but also seeing that the assets that they're bringing in are going to help, be accretive to the business and make the collective stock worth more. Anyone who can come in and see that what they're adding is actually going to drive value and continue to help cross sells for us into them. I mean, now anyone coming in, as we're getting bigger and bigger, there's more sales coming in and more salespeople across all the different companies that we have. It's driving a lot of enthusiasm to help drive new businesses or new clients into each new business that becomes part of the family. So,
And so, do you have an earnout, for cash like you did when you did your deal, or is it just cash and stock?
yeah, and two of our deals we did, we're certainly open to that, and we've done more short-term ones, whether they were just an earnout for the rest of the year, or one we did a little bit longer out than that. But yeah, I think keeping it sort of short term, so that if someone feels like, well, I'm leaving a little money on the table, okay, great, we can structure an earnout so that you don't miss that.
Right.
Um, Looking at more sort of long-term view. So where an earnout's appropriate, I think we're more than willing to do that. We have, and we've hit 100%. The two earnouts that we did, I worked really hard to make sure that they hit the earnouts. And so actually some of the cross sells that we brought in is what actually drove drove them over to make sure they hit the earnout, which then is they feel appreciated and happy with. So I think our job is to make sure that we're doing everything we can to help them, hit their earnout and
So
succeed.
can you? I'd like to spend just one more minute on that, because we hear that a lot representing sellers. Most sellers think that's just rhetoric to get me to sign, or stuff they tell you during due diligence. Can you just talk about it from the mind of a buyer, why it's important to you that those guys get their earnout, why it's better for the business that they get their earnout, and why the dollars that they're getting are relatively small in the thesis of the big story?
Yeah, I mean, it's all alignment, right? If someone hits their earnout, it means that they've actually, done more revenue, and I think that it also is psychologically, it's good for them to see us putting our action behind what we said, behind the words that we said, and actually do things that help them hit the earnout. So, they're structured in a way, and this, private equity looks at these earnouts and they have formulations for them, and then we go in and work really hard to help them hit it. And so I think it provides a longer term, trust and teamwork when you actually dig in and help someone hit something, because it's not easy to hit them, but we hit ours 100%, and the two that we structured with others hit.
And most of our clients, if you're thoughtful around constructing the earnout, our clients have gotten just about, if not all, of their earnout in almost every case. So it can be an effective tool. So let's shift then and talk about, as you look at Barrington, your capability set, what you're doing, the areas of expertise that you're lacking that you want to add. What do you think are the top of the priority stack for you there?
Yeah, so look, SEO, affiliate, influencers, podcast, OTT. There's a lot of different areas of pockets that email. There's areas that we don't have capability in, and we're looking to add. So those probably be in off the top of my head, those would be the top ones. So there's obviously some others. We'll continue to look for companies that have areas of expertise that we don't have, or channel that we don't have, as well as close to the culture as we can, so it's not as much of an integration shock.
Sure. And so let me then push for a second. So let's take SEO for a second, because you do SEO, correct?
Yeah.
but you feel like you could be better at that. You feel like you want more of that. You feel like you've got a great opportunity to cross sell into that.
Of course. Yeah. And, we let the digital teams, I started out on the offline world. And so, my true expertise is on the audio, television, direct mail sides of the business. And I think, it's exciting that we did bring in, a guy named Doug Ryan, who was, as our president of digital and with a tremendous amount of experience. He ran Digitas for North America. And, he's working great with the thesis team and Dan and Susan at 5 Mil and so forth. So, we have a lot of capacity to grow on the digital side, and I'm leaning on the executives across the board to look at, opportunities there and have them, really help decide, what pieces that we should add on the digital side as we continue to grow.
Gotcha. And so let me ask this then. So let's say we do a deal, right? You acquire a good company. You've already exceeded your expectation with Fort Point. So make it up. I sold you my company. I got 75% in cash and 25% in stock. And then you do a transaction a year from now with another private equity group. What does that mean for my stock? And what does that mean for me staying here at the company and all those kind of things?
Well, yeah. So when there's a recapitalization event, which is what we want to continue to grow the business. We want this to get over $1 billion and more, a couple $1 billion.
You said $1 million, you mean $1 billion?
Oh, definitely meant $1 billion. If I said $1 million, yeah. Well undersold there. So
okay.
Well over $1 billion to $2 billion. We built the tech frame to do that. So we're in position to do that. So to answer your question, when you do a recapitalization, it's really a nice event for those owners that came in and took stock, because they're basically able to cash that stock out and then roll what portion that they want into the new stock. So it's a liquidity event, once again, a second bite at the apple, as well as taking a look at the new deal and rolling forward what they want to. We see that as just a great opportunity and more excitement of why people would want to come and be part of this. Is that
so it's interesting. So I would imagine when you did your deal with Fort Point, they have an objective in terms of the return they're looking for on the capital they put in to the company when they acquired it, right? And private equity typically looks for a return that's 3 or 4 or 5 times on the money they invested. Is Fort Point in about that range?
Yeah, they're high. They'll be higher than that. I think they're going to be very happy with the with the result. Now we may have hit the financial pieces of it, but we still have other parts and pieces that we want to hit before we do recapitalization. So there's some concentration that we're looking to reduce. That we want to continue to build on the digital side of the business, and we want to allow some time for the integrations to come together. So we hit the financial pieces, very, very quickly and beyond expectation. There's some more, bogeys that we want to hit, as we go over the next, 12 months.
So we'll keep the math simple for this example, but let's assume that my roll forward was $1 million and the investors got 5 times on their money. Now, if I did a deal now, I was not one of the first, right? You've been doing acquisitions for a couple of years. So let's assume those guys might get 7 or 8 times on their money. I'm going to get 5 times on my money when you do a recapitalization. So the million, so I'm going to make up numbers again. I took 4 million, I rolled forward 1. Now we're a year or 2 later, you recapitalize, my 1 is worth 5 again. So I could take 2 or 3 and still roll forward another 2 or 3, because that private equity group is expecting they're going to get 4 or 5 or 6 times on their capital. Is that about right?
Well, yeah, I don't want to comment on specific numbers, but the direction in theory is right. Is that the stock, we mark to market every 90 days, and so the stock continues to go up, and yeah, we see, it actually looks like we can create more value on the next deal for the next private equity group than we did for 4 Points. So 4 Points done really well, but I think the next group will do even better because as the company continues to grow from a larger base, you just create a lot more wealth really quickly.
And do you find it on a personal level? Do you find it more interesting and exciting as you get to the $500 million number and then $1 billion, then $2 billion?
Yeah, I mean, look, I've had to evolve just like everyone else in the company, and I used to be able to get involved in every aspect of the business and understand what was happening in every account, and that's well past what I'm able to do now. And so I've had to grow and get comfortable, relying on other people to run their departments and divisions, and I spent more time on the acquisitions and with the banks and and other parts. I still love talking to clients. I still love winning business, and I still love getting out on the TV production shoots and seeing some of the creative. So I love all parts of our business. I've always been sort of a hands-on and been involved and I still get involved in some of the key hiring and talking to people, and I'm still involved in structuring the bonus plans to make sure everybody's motivated. So I try to get around, but I also realize that as the company has evolved and it's got bigger and bigger, I have to sharpen my game as well.
Sure. Hey, and to wrap us up, and I appreciate this has been super helpful and enlightening. I usually end with this question. You've obviously been super successful building this business, but I know you've also been very successful in your personal life and in your business life and community and the rest. Is there something that you would point to, whether that's a person, a mentor, whether it's an experience or a book or something that had a great influence and you would attribute a chunk of your success to?
Well, I can say my favorite book is Barbarians at the Gate, but I don't know if that contributed to my success. I did have a manager early on, a guy named Mark Hanna at the phone company that I worked for, and he had come in from IBM. He was managing their war room there, and the guy just basically worked and slept, from what I remember. And I remember I went on to his team. Everyone said, "Don't go work for this guy. He's a lunatic. All the guy does is work." And it was a good thing I didn't have a girlfriend at the time, because I think I worked straight worked and slept for six months. But I learned so much about how to manage, how to navigate in a corporate environment, how to win business, how to do presentations, all the things that you sort of need to know as a leader. But I really saw, I always had work ethic, but this guy was just incredible work ethic and really cared about his people. And so I think, I've learned so much from all the different managers I had along the way, even from the ones that were terrible. I had one terrible manager, and I learned probably just as much from him on, what not to do. So
yeah, we'll leave his name out.
Yeah, I'll leave his name out. But you take all your experiences and you take the best parts of them, and you just keep rolling forward. And I think just knowing, how to say, you're sorry at times. No leader's going to make the best decisions every day, but you just press your winners and get rid of your losers as quick as you can, and don't be afraid to to listen to your people and get consensus and keep moving the business forward. So I learned a lot from a lot of people along the way, but if I had to pick one particular person, he gave me a lot of chance to learn quickly.
Excellent. Well, I will tell you, one of the great things and the feedback I always get on this podcast is how very successful people like you are open and candid about what they've experienced, what's worked, what hasn't, what they like, what they don't. And your insights have been super helpful. So I'll say thank you for all those. I definitely would love to have you come back when you're not part of 4 Point, but on to whoever is next, right? Biggest and baddest, and just kind of follow the evolution of Barrington as it continues to move forward. So it was great having you, Peter. I wish you continued success, and thanks for spending some time with us.
Thanks, Todd.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.